The thing which is causing the price, or which everybody says is causing the price fall, has been the prospect of higher interest rates due to higher inflation, and the higher inflation is caused by the war. So, traditionally we look at political crisis as potentially being good for precious metals, although in my career I haven't really seen any strong evidence of that. We're not back in 1945 where people had to fill their pockets with gold and cross the border. But despite the political tensions, they are causing the higher oil price, and the higher oil price will feed through to higher inflation. And that basically means that the world is now expecting interest rates to rise. We've got a dead certainty of rises in Europe, the UK, and almost certainly in the United States later in this year, probably in December. So higher interest rates, at least the nominal higher interest rates, make people think, I don't want to hold gold, I don't want to hold silver because there's a carry cost, I'm earning nothing. I might as well go into short-term deposits and earn some money. The other side of the coin, I think, is that people have been, up until maybe a week ago, although that's not turned around in direction, but people have been taking money out of gold and silver to put into the fastest moving assets. And the fastest moving assets have been everything to do with data centers, silicon, AI, all that sort of thing. So we've seen almost daily for the last few weeks, last month or so, almost daily, there's 2 or 3 stocks which got 10 or 20% on the back of some story. So a lot of people have been chasing that, saying, well, okay, I missed the last one. It's hurting. Gosh, I meant to buy this, or I meant to buy that. Now it's gone up 20%. So they're kind of running a little bit, trying to find the next one. And I think the money's been coming out of gold and silver miners and gold miners, going into the AI sector. Now, of course, that sector is, as we speak, looking like it's slowing down. It's up today, but it had a very bad day yesterday.
According to Clive Thompson, gold and silver remain in bear market territory, down over 20% and 50% from their peaks. He says the U.S. may revalue Treasury gold to $15,000 per ounce to tackle its spiraling debt, warns AI stocks could go to zero, while gold cannot, and reveals why 30% gold allocation historically outperforms traditional 60/40 portfolios.
What they can do is revalue gold that the Treasury holds. The Treasury is the government. The US government holds a lot of gold. They could revalue it to the market value or a much higher value. And I think the argument is strong that they should do it to a much higher value. I picked a bit of a number out of the air and said $15,000 would be a good number. The reason I chose $15,000 was it's the number which will allow them to repay a little bit of debt which is maturing and fund the current year's expenditure. In other words, we can end the year next year with less debt and with having paid all the expenses. But let's just explain how they would do that and how it works. The mechanism is very straightforward, and it's a well-trodden route, so it can be done before. It's been done before in 1934 in a slightly different way, but more or less the same thing. The first step would be for the Treasury to sell its gold to the Federal Reserve at whatever price they declare is the new floor for gold, let's say $15,000 an ounce. The Federal Reserve pays the Treasury for the gold at the market price, which is now $15,000 an ounce, let's say. That gives the government enough money to pay all the debt, all the expenditure this year and next year, and to reduce, or rather redeem, bonds which are maturing without having to take out new debt. The Federal Reserve has now got the gold, the Treasury's got the money. The next thing the Treasury does is to buy back that gold from the Federal Reserve using what's called gold notes. Now, gold notes are not new. The Federal Reserve has already got a whole bunch of gold notes from the last time they went through this exercise. Last time the Treasury bought the gold off the Federal Reserve, they gave them gold notes. But the beauty of gold notes is this. They're not part of the national debt. They don't bear any interest, and they are perpetual. So if I borrow some money from you, and I give you a bit of paper saying I borrowed the money from you, but it's not part, I don't owe anybody anything because it's not part of my debt. So I'm feeling good. And by the way, I don't have to pay you any interest. And by the way, I don't ever have to repay you. I'm sitting pretty. In the long run, I'm very confident that we'll go a lot higher. All the factors to drive the gold price and for other reasons the silver price higher are still in place. Nothing's gone away. But one thing they used to say in Wall Street is you never fight the tape. And the tape is going down. So gold is around just a tad over $4,000 as we speak. I would much rather be a buyer of gold at 4,400 than at 4,000. Now that may be hard to understand, but when it's at 4,400, you've got a feeling that it's now moving in the right direction. And I don't want it to go to 4,400 tomorrow. I want it to gradually grind up there until I say, gosh, I'm missing out on this. I got to get in. So this is the saucer. We're going down the saucer. We don't know if we're at the bottom of the saucer. Might be there, might be there, might be there, or we might be at it. But then I want to be actually getting a feeling I'm going up the other side. Now, there's no maths or chart you could look at to tell you exactly when you're there. You can only get a feeling for it. But right now, my feeling is that if you're a stacker, as I am, it's a great move to keep buying little by little by little. But this is, for those people who are sort of saying, I'm already at my peak of silver and I want more, I wouldn't go overweight in it at the moment. I'd wait for it to go a bit lower if it does and stack up. And if it doesn't, you're fine because you've got some silver already. But if you've got no silver, definitely start buying. That's my view. But that's not a prediction it's going higher tomorrow. We don't know that. But the point is, if you stack slowly but surely, you will catch the bottom of the saucer wherever it is. So we might be here, we might be there, or we're not yet, but we might be going up the other side. Well, first of all, unless we find an asteroid full of gold, and I don't think there's much prospect of that, gold is not going to go to zero. So in that respect, it's the safest asset you could have in your portfolio. It's safer than a bank deposit, which could easily go to zero due to the counterparty risk. It's safer than some of the largest AI-related companies. Let me give you an example. The fees that everyone is paying, and it's only about 5% of those who are using AI who are actually paying fees, the fees aren't even covering the electricity costs. So people are paying in $50 billion a year to the AI companies for the usage of AI, but the electricity costs are coming in way above that. And on top of that, they're incurring this year $800 billion of capital expenditure, which next year it'll be $1 trillion of capital expenditure. The year after it'll be $1.2 trillion of capital expenditure, according to the predictions, compared with this revenue which is coming in from users of, let's call it 50 billion for simplicity, which is a tiny fraction of what they're spending. Now, capital expenditure, of course, is, in inverted commas, supposed to be an investment which generates that revenue, but that revenue isn't covering the electricity cost at the moment. So every big AI company is going hell for leather to try and sell their services below what it really costs in order to maximize users, maximize usability. So they're all working like crazy to train their models, to produce better and better models. They're going crazy to get the data centers running. They're buying the best NVIDIA chips. And all of this, the data centers, the training, the NVIDIA chips, all of this must have a depreciation rate. What if they never get, let's say some of them, never, and I'm sure this will be the case, some of them will never get to profitability and the users go away. We've got lots and lots of evidence that it won't happen. The first an obvious bit of evidence is when they revalued gold upwards by 67% in 1934, beg your pardon. What impact did that have on prices? None whatsoever. Nothing. Didn't affect the dollar, didn't affect the prices, didn't affect anything. Likewise, we've had in the last couple of years a doubling of the gold price. Has the dollar halved? No. Have retail prices doubled? No. So the rise in gold to double the price had no effect. So why would a change in the gold price to triple the price have an effect? It probably would. I don't see why it would have an effect. The only and it won't change anything vis-a-vis the money supply. Of course, the government gets a whole bunch of money which it can spend, but at the end of the day, it was going to have to get that money anyway by increasing the debt. So it would have increased the debt, got the money, spent it anyway. So all they're doing is spending exactly the same amount of money as they would have done. What we've changed slightly is the short-term money supply goes up a bit, and the long-term money supply, which is the government debt, goes down a bit. So you just have a slight rebalance. But it's really, these days, government debt is as liquid as cash in the bank. So it really doesn't change anything about the total debt. It's not going to change the prices of anything except gold and silver. So first of all, the optimal asset allocation very much depends on your start date. So if you start in 1970, the optimal asset allocation is different from your optimal in 1975, different from 1980, and different in 1990, 2020, and so on. So depending on your start date, the optimal asset allocation will be different if you're looking forwards over time. And I've done hundreds of tests, and I have a portfolio simulator on my website called Clive Thompson, which anyone can go to. It's free of charge, no registration, not even an email address needed. And you can put in any asset allocation you like to test this. You can put in any starting date you like to test this. But the conclusion is the following. Over virtually any period, i.e. any starting date until today, having some gold in your portfolio would have improved its return, it would have improved its Sharpe ratio compared with the traditional 60-40 portfolio, and it would have reduced the biggest loss. That's a peak to trough cycle. It would have reduced the biggest loss from whatever it was to a smaller loss if you had gold. Now, the optimal amount of gold does somewhat vary according to your starting date, but what I can say is, had you put in around 30% of gold at any time in history, it would have improved your portfolio compared with a 60-40. So 60-40 would be 60% equities, 40 bonds. If instead you'd had 60 equities, 30 gold, and 10 long-term bonds, you would have done better on all the metrics. Now, it doesn't mean to say that every single date in history, 60, 30, 10 was better than some other ratio, but what it does mean is having some gold. So, for example, in the last 5 or 10 years, the best ratio would have been more like, I can tell you, I've got it in front of me here. If you'd started now, if you started in June 21, that's 5 years ago, your best ratio would have been 35 equities and 64 or 65 gold. If you go back 10 years before that, it would have been 65 equities and 35% gold, zero, in both cases, zero bonds. But as I go back in time, let's say to 1991, the correct ratio would have been 48 equities, 23 bonds, and 28 gold. But overall, 30% gold would have been the perfect number if you couldn't choose your starting date. There are plenty of people out there who think they know what they're saying, who are printing prices higher than the all-time high even this year. I'm hoping they're right. But what I can say is this. We're in a silver shortage. That's confirmed by the Silver Institute, where they're forecasting a bigger deficit in 2026 than there was in 2025. That deficit has to come from somewhere, and the only way it can come from somewhere is from sellers. So it's not going to come out of the mines because the mines aren't producing enough. It's got to come from sellers of ETFs, sellers of physical bars or coins or recycled silver. The way, although every ounce on the planet has got its price, and that price does move around according to how people feel, to get that silver to meet the demand, at some point silver has to start moving higher. And when it starts moving higher, I think that becomes self-fulfilling. Therefore, people start to move their target price where I'm going to sell. So those who are willing to sell at 80 today are probably going to move their target price to 85. And and so on. And then when it gets to near to 85, they'll move it up because the momentum itself changes the way people think about what their target is. So on the way down, people gradually lower their target to 10 or 20% above the present price. But on the way up, they tend to keep their target 10 or 20% above where it is on the way up. So the silver price really has to rise to suck that silver out for the purposes of the industrial needs.